Everyone knows NVIDIA by now, but what if some of the best opportunities are hiding in companies most investors have never even heard of? Joining me now with 5 under-the-radar stocks he believes can outperform is Jed Ellerbroek, portfolio manager at Argent Capital Management. Jed, so good to have you on.
Hey, Caroline, nice to see you.
Nice to see you as well. So Jed, your top 5 are all mid-cap stocks. Why should investors look at mid-caps at a time when so much money is flowing into mega-cap tech?
Yeah, great question. Mid caps, I think, are an under the radar asset class. We all spend so much time talking about and thinking about the big, large cap stocks. Um, and actually, there are a lot of people that are interested in small cap stocks as well. And it feels like mid caps are under the radar and missed by investors frequently. It's also a pretty strong performing asset class. There are lots of proven, capable, impressive, highly profitable, and growing businesses that occupy that mid-cap space. So we think it's a nice niche.
So make the case for why they should be on our radar right now.
Sure. Yeah, there are a bunch of companies in the mid-cap space that are going to benefit from the AI build-out. There's also a lot of companies that are in other industries that are growing and highly profitable, like aerospace and defense. Merger and acquisition finance. We're going to talk about a couple of those today. So there are a lot of really good companies operating in appealing industries for investors.
Okay, let's get right into your picks then. Number 1 on your list, AMETEK, ticker symbol AME, which is up about 10% year to date. What does this company do that makes it a potential long-term compounder?
Yes. AMETEK is a well-managed, diversified industrial business. Their primary end markets are aerospace and defense and healthcare. Those are 2 growing areas of our economy. And the company supplements the natural organic growth of its portfolio companies by making acquisitions of other proven, capable, growing businesses. And then once they buy those companies, they try to improve their operational processes, get profit margins up, etc. So that kind of merger and acquisition flywheel has fueled the business and helped them grow north of the typical industrial growth rate over the last 15 or 20 years. So we like the management team, we like the capital allocation. They're serving growing industries and doing a good job operating their businesses.
Okay, next up is UL Solutions, ULS, which has actually been an outperformer this year, up more than 20% year to date. People probably recognize the UL logo on their appliances, but they might not know what the business behind it actually is. So what's driving growth, and why is this the company that competitors can't easily replicate?
Yeah. Even people like you and I, probably not an expert on the mid-cap space, Caroline, but even you're familiar with that Underwriter Labs logo that we see on so many of the devices and services and products that we buy. Their brand is very powerful. They're the dominant company providing these certification and inspection services. If you're building products, you'd be crazy not to go to them. And so that gives them pricing power and the ability to dominate the market, which we think is really important for long-term profitability and growth. Their business is growing. AI is going to result in more products, more electronic offerings from companies. We think down the road, and they're going to be there to serve them as they need that certification and impression for customers. So we think it's a good business, and also they're recently public just within the last couple of years, and they're really focused on improving their profit margins. We think there's a long way to go there.
Okay, next up is MedPace Holdings, MEDP, which is down more than 20% year to date. This company runs clinical drug trials for biotech companies. When a stock falls that much, though, investors might assume something's broken. So what does the market have wrong here?
Yeah, the stock has been really volatile over the last 2 years. Biotech funding was weak for most of 2025. It's starting to improve now. And so MedPace is an exceptional company. If you look over 10 years, it's probably one of the better performing healthcare stocks in the entire U.S. equity markets, but has been weak lately. We think that's an opportunity to buy a really good company at an appealing price. We think that as 2026 and 2027 goes along, we are going to see biopharma funding increase. We're going to see drug trials by those biopharma companies start to increase. And we think AI is going to make drug discovery better, quicker going forward. So we think that's a long-term tailwind for MedPace and its industry. So we think that's a very appealing investment, especially here and now in June 2026.
Next up, Houlihan Lokey, HLI, another underperformer. Despite record revenues, the stock is still getting crushed. What's Wall Street missing with this one?
Yeah, investors are concerned about rising interest rates, and I think that that's probably the thing that's hurt Houlihan Lokey most acutely over the last couple months. High interest rates reduces merger and acquisition activity, and Houlihan Lokey is the leading middle market investment bank here in America. They're not doing the huge IPOs. They're not going to be involved in SpaceX's IPO next week, but they're involved in capital formation and M&A, advisory activities for middle market companies and transactions that don't hit the headlines every day. They have a very strong market position there. It's a well-managed business. They do acquisitions to supplement their growth. They're particularly focused on building out their presence in Europe most recently. And we think that this is really a strong investment banking environment. Equity markets are at or near record highs depending on the day. GDP growth is good, probably accelerating a little bit. Interest rates are still a little on the high side, but I think President Trump would sure like to get them down, and he just picked a Fed chair that he believes is likely to lower them when he can. And so we think that the environment provides nice tailwinds for Houlihan Lokey's business. We think it's a well-managed business, and we think it's a really good investment today after this most recent drop.
What happens to this name, though, if rates do stay higher for longer? Because the expectation now is that the Fed won't be able to cut rates this year based on inflation.
Yeah, higher rates would slow their growth. I think the company would still grow, just grow slower. One thing about Houlihan Lokey I didn't mention is they have a second business that's kind of counter-cyclical to their primary investment banking business, and that is a restructuring advice business. Obviously the restructuring business has been weak lately. The economy's been really good, but if interest rates do go up, if our economy does, enter recession by chance, that is always a nice ballast and stabilizer for them compared to other investment banks. So if you're looking at a universe of investment banking businesses, Houlihan Lokey is actually more defensive than most because of that restructuring piece.
Okay, finally, Heiko Corp, HEI. This stock is up modestly year to date. The company makes replacement parts for aircraft. Why is now the right time to own this name?
Yeah. Aerospace stocks have been on the weak side lately. I guess that's not exactly true for Heiko. Like you cited, Heiko reported earnings, in late May that were quite strong. Their revenue growth was, in the high teens. I think the stock was up 10 or 11% that day. So that stock has had a bit of a rebound here lately. But over the last couple months, it's been down due to the U.S.-Iran conflict. Investors are worried that higher oil prices has caused airlines to trim their flight schedules, which means there's going to be less need for the types of aftermarket products that Heiko sells come 2027 or 2028. So that's what's dragged down the stock lately. Their earnings most recently picked it back up a little bit, but we think it's a very good business. Aerospace aftermarket is very appealing. As people get wealthier, they want to fly more. So that's a good thing as stock markets rise, globally, and they have a very strong competitive position. Their product strength is actually in replacement, like kind of non-branded replacement parts. So almost like generic foods in a grocery store. They're selling generic aftermarket aircraft parts and helicopter parts, anything that flies really. So there's a price advantage there, and Heiko has consistently grown faster than peers because they offer that price advantage. So we like that business a lot. It's a long-term, industrial compounder with very good management.
All right, but if you take a look at the charts, a name like NVIDIA, which I started with, is up more than 400% over the past 3 years. Why should investors buy these stocks instead of simply sticking with the large cap winners that have already been working?
Yeah, I think it makes sense to do both. I think that, an investor wants to have a diversified equities portfolio. I think that means you want exposure to some of our leading AI and technology and semiconductor businesses, like your NVIDIA example. I think you also, though, want exposure to non-tech, high quality, durable growth companies that trade at reasonable valuations. And so what we tried to do today is compose a list of 5 under the radar mid-cap ideas that we think investors would be wise to own, in addition to a lot of those companies that are leading our stock markets today, the Nvidias, the Googles, the Amazons, etc.
What's the catalyst that gets investors to start paying more attention to mid caps?
Yeah, man, I wish I knew the answer to that question. That's a great question. We're on year 4 of a really massive bull market. The stock market has more than doubled over that period, and it's been led, as we all know, by those big tech companies that are benefiting from the AI data center build out. When does that just take a pause for even 6 months, much less reverse? I'm not sure, but I do know that if you buy and own high quality, well managed, compounding businesses that can grow their earnings, 10 or 15% a year, you're going to do well. I can't tell you when exactly, but over the long term, that strategy will pay off, and so that's what we kind of fall back on.
Okay, all right, a perfect time to pivot to our rapid fire round. Quick questions, quick answers. Are you ready, Jed?
I'm ready. Let's go.
If you had to put your entire retirement account into one of these 5 stocks, which one is it?
Ooh. I think Heiko would be my choice. Yeah, just their like kind of long-term track record. They've been doing it for 30 years. This management team, this family, I think they'll keep it going. My trust is there.
Which stock has the best chance of doubling over the next 5 years?
I think ULS and their consistency, non-economic sensitive, that one I think is probably the highest likelihood.
If you had to drop one from the list, which would it be?
Amatech. That diversified nature of their industrial base means that they'll be consistent and do well, but they're less likely to kind of shoot the lights out.
Which stock would you buy immediately on a 10% pullback?
Heiko.
Which stock is the most resilient if the economy slows?
Amatech. That diversified portfolio helps in that scenario.
MedPace or Houlihan Lokey, which rebounds first?
MedPace. I think biopharma funding is coming back quick.
Which benefits the most from continued AI spending?
Houlihan Lokey, I think. I think an underappreciated fact about AI is that it is increasingly dependent on capital markets financing. And so equity issuance and debt issuance is rising fairly rapidly. And Houlihan Lokey benefits from that.
Which stock on this list do you think investors are most likely to regret not buying 5 years from now?
Heiko, similar to the justification for my first one. That's one you can really trust and rely on.
What stock would be number 6 on your list?
US Foods, which is sounds like a pretty boring distribution business, but they have a really strong competitive niche, and they're substituting branded goods for generics, which they earn a higher profit margin on, and it's a very well managed, kind of under the radar company. USFD is the ticker.
Jed Ellerbroek, Portfolio Manager, Argent Capital Management. Thanks for playing along. Thanks for your top 6 picks. Really appreciate it.
Yeah, fun game. Thank you for having me. Have a great day.
If you enjoyed these picks, check out our full interview with James Demmer, where he reveals the top 5 international stocks that could beat the S&P 500.